Thank
Yeah.
you.
Welcome everybody to this expert talk with the Dutch NGO Skyfinity about their views on the aviation startup funding ecosystem and some techno-economic perspective on the sustainable aviation transition and how to accelerate it. We are Safe Landing, and Safe Landing is a global community of aviation workers who act from within the sector to rapidly reduce the climate impact of aviation. And our diverse group consists of pilots, cabin crew, engineers, ATC experts, aviation managers, and many more. And we empower you to work effectively on the sustainable aviation transition. So together we change course towards a safe landing. This lunch session today, we are very thankful to have Maurice Boon with us, the founder of Skyfinity, and he will give insight in their work at Skyfinity, which is a Dutch registered non-profit foundation and dedicated to reduce barriers for sustainable aviation startups in the sustainable aviation supply chain. Skyfinity's goal is to catalyze the sustainable aviation revolution and support the industry's target of net zero carbon emissions by 2050. Maurice Boon is passionate about technology, strategy, and sustainable transitions. He's an aerospace engineer with an MBA from INSEAD and 9 years of experience in the aerospace and mobility sectors. But who's best to introduce Maurice himself? Maurice, can you tell me what made you decide to start Skyfinity and take us with you on this journey?
Oh, yes, of course. Thank you, everyone. Nice to meet you. And thanks for the lovely introduction. I don't think I need to add much more to it. But the driver that I've seen in the past couple of years, or the driver to start Skyfinity, is that I've seen many of the technologies that are being developed. And I see that the technology solutions development is possible. A lot of technologies are feasible. Yet the ecosystem is still facing many complexities with the financing and the organizations of the international cooperation, which basically provide additional barriers. Well, I've seen many startups and see how long it takes for them to make a product go to market. And that's why I started Skyfinity, trying to bridge that gap, that knowledge gap, that finance gap between the different perspectives of startups, technology, financiers, and policies. And that's the start of Skyfinity. And yeah, if you allow me, then I can continue now with my presentation. All right, let me share my screen.
Yes, please.
All right. Hope you can see my screen right now. So today I'd like to discuss a dialogue about finance and innovation for low carbon aviation. And let me go to the next slide. Yes. As already shortly introduced, Skyfinity is really there to catalyze an effective development and implementation of sustainable aviation. And with effective, we basically mean that what we do is already complex enough that it's better to do it as effectively as possible, with the least amount of iteration, the best alignment between startups and other industry stakeholders. And that's what Skyfinity is trying to catalyze by bringing technology perspectives, economic perspectives, and policy perspectives, and bring them together. And so today we've basically prepared two little case studies, one on the early stage investment ecosystem for startups, and the other one is the more mature financing system for aviation. And we want to look a little bit at like, how do these ecosystems develop and how does it affect startups and scale-ups in this industry? Because everything is still in the early stage. Well, I hope that you can take two key takeaways away from this one. First of all, Europe has a very strong innovation potential, but there's a misalignment between different funding sources. And on the more mature finance, we see that the risk-return balance right now is still severely hampered by a lot of uncertainty. And these uncertainties make it very tough to get sufficient investment going. And if we don't align them better, then achieving our goals to reach net zero will be more and more effective. And basically there's somewhat of a snowball effect. If you can quickly scale it up, then the market has a stronger belief in these transitions. And if it just goes slower and slower, it becomes harder and harder. Let's start with the first case study. And to structure our thinking a little bit, just some basics on the structure of this ecosystem. So as we are strongly dependent on technology, we're also right now dependent on maturity stages and development processes of these technologies. And we structure them basically in the following stages. We have the early stage startups and R&D at, well, startups developing early stage small products, and a lot of R&D being done at research organizations and also universities. Then there's the product development where more commercial technology is integrated, and that requires different types of financing. And then once products are approved, the legislation is in place, then the scale up happens. And that is a very different type of financing. And the last one, then you have the operations where most green solutions right now result in a green premium on ticket prices. So regulating of how to deal with green premiums in a very competitive market is also very important. So basically, we have to combine technology developments, the tech mechanisms, and the finance mechanisms, and see how they line up to see how effective this industry actually is performing in a sustainability transition. So the first case study is focused more on the startup and R&D phase, and the second case study is more focused on the scale up. To just take a few takeaways from it. So then to start, IATA, ICAO, and Waypoint 2050, they provided studies of how much capital they think is required to reach net zero in 2050. So it's like a sum of the total investments required that are on top of the business as usual investments. And so they estimate that we need around $4 trillion. And basically that is such a big amount that we don't have any feeling with it anymore. So they've divided it up in three groups. You have the technology development, so a lot of new technologies for hydrogen or hybrid electric aircraft. Then we have the scale up of SAF fuel plants. And then eventually also have the price premiums on the new products. So right now we'll only focus on technology development and SAF. And they estimate that we need between 6 to 11 billions per year on technology development. And ICAO is saying that the R&D for incremental innovation in the industry is roughly 50 billion per year. So they say that it should be possible to reallocate that money to more radical innovations because that's roughly in the same size. And then if we look at SAF CapEx investment, which are estimated at 48 to 120 billion a year, we see a similar comparison where we look at oil and gas industry roughly investing $420 billion per year in new energy plants. So if we want to take SAF, which is like only a portion of it, they need about like 10 to 30% of the global investments to make it happen, which is a lot. And in order to do so, we still need to develop a lot of technologies through research institutes, startups, and consortiums of established organizations. And that's what I'd like to follow on in the next case study. So we've done a case study on investments in about 120 startups. And this slide is a little bit of information overload, but the key takeaway here is that we segmented them in 5 subsegments. So we have aircraft level technologies, we have fuel technologies, multi-industry technologies, infrastructure, and zero emission airlines. And we're going to look a little bit more in dynamics of these subsegments. So first of all, and this is by no means a complete picture because we really looked at the high level startups. And of course, there are more smaller and sub-segment startups or startups that are in multi-industries. But basically what we see when we really look at the core of these sustainable aviation startups, that the sustainability and connectivity paradigm basically results in a growth of startups. Aviation is traditionally not really a startup ecosystem, but this new paradigm is really changing that ecosystem, accepting new technologies being developed at a much higher pace at these startups, but also the industry is looking actively at new business models and smaller segments to develop the products in. So that gives opportunities for startups. Then if we look at the funding in these 5 segments, we can recognize a couple of trends. We've looked at like the public available information, and we can see that in the last 20 years, about 6.5 billion euro is invested, dollars is invested in sustainable aviation startups. And most of this has been invested in SAF, in fuel development technologies. And this is an interesting fact because if we look at the amount of startups, we see that most of the startups are based in the aircraft level technology, which is roughly 50%. And they're able to attract a much smaller segment of the funding to develop their technologies. While SAF is roughly a quarter of the companies, but they're apparently able to attract about 50% of venture capital investments. We can see a similar trend if we look at regions. So here on the right, we have compared startups, funding, and investors, and we can clearly see that the EU has roughly 60% of all startups related to sustainable aviation. However, the venture capital ecosystem is much more mature in the US. So that's a traditional situation, but it's very surprising that Europe has so much more startups in this space. And so for European startups, it's much harder to attract the right type of capital. Basically, what we see is that aviation doesn't really have specific venture capital funds dedicated to aviation. And that makes it harder to attract capital because hard and software investments are already much harder to invest in. So basically what we think is that startups are looking for three key factors in investors. They're looking for funding, they're looking for talent, and they're looking for test environment to test their technologies at laboratories or testing environment at airports. And basically we see because of these requirements, startups are willing to relocate to different locations. So there's a number of startups that are willing and able to go to different locations in the US or in Europe to align with subsidies or align with test environments to be able to develop their products. I think that's an important characteristic to recognize. On top of that, there's differences in how funding is allocated to startups. Europe and the US have roughly invested the same amount of subsidies in startups. Yet in Europe, those are much smaller amounts and invested in many more startups, where in the US, startups are able to attract much more subsidies directly from ministries. In Europe, we have stronger regulation on unwanted state support. It needs to be combined with private capital. And as a result, we see that in the US, it's much easier to attract subsidies, which in the end result in a much stronger attraction of private capital. So the alignment between subsidy that will eventually result into private investors is much smoother in the US than in Europe. That's just because of the different cultural, basically the different ecosystem approaches of these environments. So then another trend that we're seeing, startups have to go, of course, through different development phases. They go through the development. First, you have grants and seed, and then you go through series A, B, and C. And through each of these stages, the technology needs to be more mature, the product market fit needs to be more mature, and the companies need to more and more prove that they can actually turn this business into an economic business case that works. But what we see in aviation is that there's basically a valley of death in investors. It's relatively easy to get some subsidies and seed because these organizations are available and willing to take the risk. However, when you reach Series A, when there's still no product market fit, yet the technology needs more investments to develop, there's much less investors willing to take this risk, while the capital need is already increasing. So the need for funding is much higher, but the available sources is really decreasing. And so we see here a strong mismatch in the ecosystem to make that happen. And that's basically hampering startups in their development. So we're saying at Skyfinity, we need not only innovation in technology, but also innovation in finance to make this ecosystem more effective in development of new technologies. One trend that we've seen in Europe is that many subsidies have been allocated more to consortium of established organizations. I've listed a couple here on the slide. So Europe thinks that is an easier way to get buy-in from the industry, while the US is much more directly investing in startups and taking quite strong investments in 50 to 100 million euros in early stage startups, which is quite a strong difference. So basically at Skyfinity, one of the approaches that we are looking at, initially we were trying to promote a offset mechanism where we ask passengers who want to offset to not plant trees, but basically invest in a forward-looking investment fund. And right now we're trying to promote the ideas of more dedicated venture capital funds in sustainable aviation, where innovation airports, industry partners, and academia come together with capital to make alignment between technology, policy, and investments. And if you have these industry partners together, you can actually bring the benefits that startups need and get a smoother alignment between these different parties. Then a couple of generic trends. So hardware startups generically face a much harder environment to attract capital. So I'm not talking only about aviation right now, but hardware in general. What we've seen in some analysis, and this is done by Planet A Notion, they basically see that clean tech face an ecosystem where, of course, in the first generation around the early 2000s, a lot of clean technologies got a lot of investment, but venture capital funds lost a lot of money on this. It was a little bit too early at that point in time, so they become more risk averse to this situation right now. Of course, if you invest traditionally more in software, it's easier. There's a shorter time to market, there's higher margins. And for hardware, this is different. It requires more capital, it takes longer time to market, and the margins are lower. But on the other hand, the business case is more stable over a longer time. So the risk profiles of these type of hardware startups is very different from software startups. And basically it means that VCs, they usually look for the highest return on investment and don't have the expertise to understand this hardware environment, which makes it much harder to attract capital. And on top of that, what we see, if you start looking at climate tech investment, you see that there is still a mismatch between abatement potential of technologies, the economic potential, and technology performance. And if we look at the total investment in climate tech, we see that mobility and transport has received about 60% of investment, while their climate impact is only 20% of the global greenhouse emissions. And in other industries, investments are much lower. Aviation is, of course, part of this mobility and transport, but it is a separate segment that has been underinvested. If we look, for example, at space or at pharmaceutical industries, they receive about 19 billion to 30 billion of venture capital per year, while aviation has received roughly around 400 million venture capital investments per year. So there's a very strong mismatch in aviation regarding this funding ecosystem. But I think startups can also improve a little bit here, because a lot of startups in aviation, they live on hypothesis based on, yeah, we're building an electric airplane, for example, that has less noise, less emissions, but they don't quantify it. So they can help themselves by doing initial life cycle assessments and building more techno-economic assessments to communicate their message stronger and easier. So that was the study on startups. Now we go a little bit into the more mature investments, and that's right now in the sustainable aviation fuel. I first want to start with a couple of trends. Right now, about 85% of SAF supply is based on unused cooking oil. And if we look at this graph of supply or import of used cooking oil, you can basically see how volatile the availability of feedstocks are. And this makes business models for these kind of plants a little bit risky. So the more we depend on these kind of feedstock, the less critical it is, and also prices will go up. And that's also what I want to focus on a little bit right now. Just a couple of indications on prices. So right now, if you look at the whole biofuel space, we can see that the used cooking oil is roughly at the same price of kerosene right now. And the used cooking oil is just an input for SAF. So you still have the additional process cost as well. And that basically means that it's going to be very hard to be price competitive on the long run. So right now, we see that there is also a very large green premium on this SAF. We've seen a strong reduction in the spot price of dollar per megaton of SAF. We started at 4,000 right now, we're roughly at $2,000. But the green premium on top of kerosene is still around $1,200. So still a 2.5x of kerosene prices. And this green premium is difficult to really bring down on the long run. And right now, what we see, if we compare SAF, right now SAF is early stage, but if you look at the total renewable fuel ecosystem, we see that SAF is roughly 3% of the entire renewable fuel space. While the interesting thing is that the prices for SAF are much higher than for renewable diesel, for example, and that is a consistent trend. So we've seen, if you look at the latest prices right now, it's $2019 per ton, where in diesel it's roughly $500 lower, and this is quite consistently. It will take a little bit of investment to convert existing plants to also be able to produce SAF, but once that is done, it's very easy to shift between them. So I'm still a little bit surprised that these plants are not able to make these type of investments. Because in aviation, we see as well that every drop of SAF that's being supplied right now is being purchased at high prices. So supply is still much lower than demand. Then I just wanted to give a little bit of an overview of where we are. We've done a little bit of a study on the available plans for sustainable aviation. And right now, there are roughly 29 plans that we can find in public information. Another source, they said there are 33 operational right now, but we could find only 29. And if we look at the amount of SAF that they are producing right now, that is roughly, in 2023, it was about 600 million. And that is less than 0.2% of the total availability or total need of fuel for sustainable or aviation. So we're very far from where we need to be. But in next coming years, we will have, of course, the SAF mandates becoming active. So the demand for SAF will increase. So that will change the game a little bit. And there is a strong intent to build more SAF plants. And if we look at the planned SAF plants for 2030, we see a very strong increase. We go from 29 to about 185 plants, strongly concentrated in America, Europe, and Southeast Asia. But even if you look at total capacity that's right now planned, we see that's roughly 43 billion liter, which is roughly 3% of SAF in 2030. So it seems if all these plans will be successful, that it's possible for Europe to comply with their SAF mandates, but it's still a massive challenge to scale up afterwards. And this is not a given that this is going to happen. If you look at the windmill of the wind farms that are being produced, the International Energy Agency says that roughly 30% of projects actually goes to final investment decision. So if we have a similar success rate in SAF plants, then we need many more projects to start. On top of that, there's a whole number of first mover challenges right now. And some of these early stage startups are already facing challenges. Recently, last week, Fulcrum said that they're facing bankruptcy and basically laid off nearly all their employees. And if we look at some studies from the European Investment Bank and also of the ICF, we can see that there's still a lot of risk in this industry to overcome, to align investors to invest. And it has to do with market risk. For HEFA, it's really the feedstock, so that's a market risk. And for alcohol to jet, Fischer-Tropsch, and power to liquid, you see technical risk. You see the capacity or the availability of green energy. Then there's the technology risk of new technologies, and many more. And that is basically going to affect the finance of these large-scale projects. And the type of investments that you have with this is project finance. And project finance, though it's quite a boring name, is quite a unique investment vehicle. Project finance basically means it's an independent organization that is established to operate, develop, construct, and operate a single-purpose asset, in this case, a SAF plant. And basically, it means this project has a start and an end at which the company is dissolved and the final distributions are made. But in order to make this successful, you have to understand the deeper development, the deeper characteristics of this finance. Project finance is unique because if you look at an asset, for example, you buy a house, the value is in the asset itself. It's multi-purpose. You can sell it to someone else, they can live there. If you build a SAF plant, it's not that if you sell it to someone else that they are able to produce SAF. The inherent value is not in the asset itself. The inherent value that you basically create value is by the contracts that you have, which creates the money. So in this case, that is the offtake agreements with airlines, fuel producers, etc. And in this is why everyone is always talking about in SAF, you need bankability. And if you have an offset agreement of 12 years, then it will be easier to get the funding. And funding is a combination of equity and debt structures. And for debt structures, you really need like this bankability issue to solve. Otherwise, the risk for banks or multilateral institute is too high. But for sustainable aviation, this is a little bit harder because right now it's a new industry. It is not a proven industry. There's a lot of new technology. So while this being developed, the risk for banks are really high. So they're much less willing to provide a sufficient debt to make these projects work. And I can understand as well, because if you look at the capital required to make these projects finance, it's very large. A typical statistic for project finance is that most of the investments are less than 500 million. That's like 63%. While if you look at the size of SAF plants, most of them are between, well, hundreds of millions to billions. So if you look at HEFA plants and you use existing equipment, then it's a couple hundred millions. But if you build a bigger one from scratch, you're already reaching low billions. And then if you want to use alternative technologies, alcohol to jet or Fischer-Tropsch, the capital expenditure is going to increase a multitude of that. These are just indicated figures, but basically I want to indicate here that the complexity of technologies requires a capital expenditure which is on the higher end of project finance, and that makes it even harder to attract the right type of finance. So in this space, it's really important if we want to scale this up quicker, that we reduce the technology risk, that we basically get more alignment between offtake agreements between airlines and fuel producers, and basically then it's easier to get a sufficient debt to make these projects happen. So that's on some perspectives on how this SAF industry is being financed. On Skyfinity, we're trying to do our part. We're exploring right now to build a techno-economic model. We're in the early stages of this, but we want to build a techno-economic model where we can model the technology performance of the most common technologies in sustainable aviation, also look at the emission potential, the abatement potential of these technologies, basically then link that to the finance and development of these kind of structures. You need different types of finance structures, different types of development timelines, and basically then you can start building scenarios for net zero on a techno-economic level. So it's going to be a high level to really get a better understanding between different technologies and what kind of knobs can we turn to make this transition more effective, or at least show a bit more of the structures behind it. And that brings me to the end of my presentation. As Skyfinity, as a non-profit, we try to support this industry where we can. And building this techno-economic model, really like to work together with industry and everyone that has knowledge on it. We'd like to build case studies with startups, but also scale-ups on their economic model and see if we can validate the model with them. So if you have any knowledge on this and would like to work with us, feel free to reach out. And I want to thank you for your time.
Well, thank you, Maurice, for your presentation. I'm blown away by all the information about the funding and stuff. It's not the first thing you think of in the most times. So I think we have lots of questions for you. We will continue with the Q&A. Maybe we want to stop the recording for now.